If you've been reading the agricultural trade press for the last 6 months or so, the mood has been, well, let's just call it what it is.
Grim.
Yeah, grim. It feels heavy out there. We've got commodity prices just dragging along the bottom.
Right.
Farmer sentiment is really low, and the general consensus out there is that we are deep in the winter of the agricultural cycle.
Winter is a very polite way to put it, actually. I mean, most analysts were bracing for impact.
Exactly.
The whole narrative recently has been about cost-cutting tightening belts and just trying to survive until the cycle turns.
So the expectation for Deere Company's Q1 2026 earnings report, which dropped this morning, February 19th, was that they would at best sort of limp across the starting line.
That was the expectation, yeah.
Maybe show a few bruises, offer some apologies, and definitely lower expectations for the rest of the year.
But that is not what happened.
Not at all.
It's actually kind of shocking how far off the consensus was.
Instead of a stumble, we got a sprint. It was a massive beat and raise that, frankly, defies the gravity of the current economy. So for our deep dive today, our mission is to figure out how they pulled this off.
Because it really doesn't make sense on paper if you just look at farm incomes.
Right. We need to unpack how a company facing a 15 to 20% industry decline in its core business managed to beat revenue expectations by over $2 billion.
A massive number.
And we also need to figure out what their CEO, John May, means when he plants a flag and calls 2026, quote, the bottom.
That's the key narrative thread we need to pull on here, the bottom.
Yeah.
Because it implies we are done with the free fall and moving into stabilization. And the data they released today and the sources we're looking at supports that view in some really surprising ways.
So before we get into the machinery in the mud, let's hit the headlines. Because the gap between what Wall Street expected and what Deere actually delivered is huge.
It's a chasm.
Right. Analysts were expecting earnings per share of roughly $1.90. Deere delivered $2.42. That is a huge beat.
And the revenue spread is even wider. I mean, the expectation was around $7.5 billion.
Yeah.
Deere reported $9.61 billion in net sales and revenues.
Hold on, I want to pause on that number for you. $9.61 billion versus an expected $7.5.
Yeah.
That is a $2 billion miss by the analysts. How do the experts get it that wrong? Is the market just totally disconnected from reality?
It's less about disconnection and more about pessimism, I'd say. The market had priced in a disaster. They assumed that because corn prices are down, then absolutely everything Deere does must be down.
Because they just think of them as a tractor company.
Exactly. But Deere isn't just a tractor company anymore. They have diversified significantly. And frankly, the analysts really underestimated just how good Deere has become at execution.
Execution meaning what exactly?
Meaning getting products out the door and invoicing them, even when the supply chain is messy or the macro environment is tough, they are operating very efficiently.
And usually, when you see a beat like that in a tough market, companies are still really cautious about the future. They say, hey, we had a great Q1, but don't get used to it.
But Deere did the exact opposite.
Right. They raised their guidance.
They did. They bumped their full-year net income forecast up to between $4.5 and $5.0 billion.
Wow.
And they also increased their projection for cash flow from equipment operations by $500 million.
Which tells us this wasn't just accounting magic or a one-time tax credit or something. They actually expect to make more money selling things for the rest of the year.
Precisely. It signals extreme confidence in their order books. They aren't guessing here. They are looking at orders that are already locked in by customers.
Okay, so let's dig into where this money's actually coming from. Because if the big grain farmers aren't buying record numbers of combines right now, and we know they aren't, someone is buying something green.
They are.
And looking at the segment breakdown, it seems like the star of the show wasn't the farm at all.
No, it wasn't. It was the job site.
You're talking about construction and forestry.
Correct. Construction and forestry, or C&F, saw sales jump 34% year over year.
34%. In an economy where we keep hearing that housing starts are subdued and interest rates are high, that just doesn't add up for me. Who is building stuff right now?
Well, that's the nuance you have to look for. Housing is subdued. If Deere relied only on suburban driveways and new residential subdivisions, they'd be in serious trouble.
Right.
But they are benefiting from what they call mega projects. We're seeing massive U.S. government infrastructure spending finally hitting the dirt.
Literally shovels in the ground.
Exactly. Roads, bridges, big civil engineering projects.
But there was another driver they mentioned in the report that caught my eye, and I want to push back on it a little because it sounds like a buzzword bingo card.
Oh, the data centers.
Yes. They explicitly called out data center construction. You're telling me that ChatGPT is selling bulldozers? That feels like a stretch. How much of this is real versus just Deere marketing trying to ride the whole AI wave?
I know it sounds like marketing spin, but look at the physicality of the cloud. We think of AI and the internet as these ethereal digital things,
Right, it's in the cloud?
but they live in concrete. A single hyperscale data center requires grading hundreds of acres of land, trenching for massive power lines to handle the electricity load, and pouring millions of tons of concrete.
So it's not the servers themselves, it's the physical shell they sit in.
Exactly. And unlike a residential subdivision, which might use light equipment, these data center projects need the heavy earth-moving gear. The big 1050K dozers, the large excavators.
Wow.
Deere's report specifically highlighted data center construction starts as a primary driver for their earth-moving equipment demand right now.
That is just wild to think about. The boom in large language models is literally moving dirt in North America.
In a very direct way, yes. And the metrics back it up. Their order bank for construction equipment grew by over 50% in the last quarter.
50%?
The highest level since May 2024. And retail settlements, which is when the machine actually gets into the customer's hands and gets paid for, those were up mid-teens.
So this isn't just dealers stocking up hoping to sell. This is equipment going to work immediately.
Exactly.
Okay, so construction is the heavy lifter here. But there was another surprise for me in the report. Small ag and turf. Feel like we often gloss over the small stuff, but sales there were up 24%. What is driving that?
It really comes down to a tale of two farms. While row crops like corn and soy are struggling, you have to look at the other side of the agricultural economy. Beef prices are incredibly strong right now.
So the cattle ranchers are making money.
They are having a great year. The dairy and livestock sectors are highly profitable, and when a rancher makes money, they buy equipment. Mid-sized tractors, hay ballers, utility vehicles.
So the guys growing the food for the cows are struggling, but the guys raising the cows are buying tractors.
That is the dynamic we're seeing. Plus the turf market, so things like lawnmowers and golf course equipment, that is normalizing. After a post-pandemic slump where everyone had already bought a mower, we are seeing a return to growth there too.
Which brings us to the elephant in the room, the core business. Production and precision ag.
The big iron.
Yeah, the massive 8R tractors and the X9 combines. This is usually the bread and butter of Deere. The report says sales were up 3%, which sounds okay until you look at the operating profit.
Which dropped 59%.
Yeah, that is a brutal number. So sales are up slightly, but profit is way down. Walk me through that. How does that actually happen?
Well, a few things are happening all at once. First, that 3% sales increase. That was almost entirely due to foreign currency translation.
Meaning what exactly?
Meaning the weak dollar made overseas sales look higher in dollar terms. If you strip out the currency effect, volume was actually flat or slightly down.
So they didn't actually sell more machines in reality.
No, they didn't. And the profit drop came from a mix of higher warranty expenses, an unfavorable sales mix, meaning they sold fewer of the super high margin machines relative to the standard ones, and tariffs, which we will definitely discuss in a minute.
And they are still forecasting the North American large ag industry to be down 15 to 20% this year. So they aren't pretending everything is rosy in the Corn Belt.
Not at all. They're being very realistic about the headwinds, but, and this is the crucial part for you to understand, the beat in this segment wasn't because the market suddenly recovered, it was because of execution.
Right, you mentioned that earlier.
They shipped products faster than planned, they managed their internal costs, they are navigating a downturn efficiently rather than being crushed by it.
Which leads us back to the CEO's comment about 2026 being the bottom. If large ag is down 20%, why are they so optimistic that we're turning a corner? Where are the green shoots?
There are three main signals they highlighted in the call. First is order velocity. Despite the gloom, the order books for large tractors are now filling up all the way into the fourth quarter of the fiscal year.
So farmers are committing to buying even 6 to 9 months out.
Exactly. Second is the early order program for combines. It finished much better than they expected. But the third signal is the one that I think is most significant for the long term. It's the inventory story, specifically used inventory.
Oh, right. This is the whole nerd nook stuff about used equipment values.
Yeah.
I know this matters, but explain it to me like I'm 5. Why does the price of a used tractor determine if Deere sells a brand new one?
Think of it like the housing market. If you can't sell your current house, you can't buy a new one. It's the exact same with tractors. We call it the trade ladder.
The trade ladder.
Yes. Most farmers trade in their old machine to buy a new one. For the last year, dealer lots have been absolutely overflowing with used equipment. Because there was a glut, prices for used tractors crashed. That meant when a farmer went to trade in their 2022 tractor, the dealer offered them a really low-ball price.
Makes sense.
The farmer looks at that trade-in value and says, forget it, I can't afford the upgrade. The ladder is broken.
So the new sale dies because the used sale is stuck.
Exactly. But Deere reported significant progress in clearing this glut today. Used 8R inventory is down over 10% from its peak in March 2025.
That's a good start.
But here is the really crucial detail. The inventory of late-model used tractors, so the 2022 and 2023 models, dropped over 20% in just one quarter.
20% in one quarter. That is moving metal fast.
It is. It means the market is absorbing that used equipment. That unblocks the trade ladder. If a dealer can sell the trade-in, they are much more willing to give the farmer a good price for it, which unlocks the sale of the new machine.
And I suppose the macro environment is helping a bit too. I saw a note in the sources about China and some government aid.
Yes. China has resumed purchasing U.S. soybeans, which stabilizes commodity prices. Plus, the U.S. government launched this $12 billion Farmer Bridge Assistant Program.
And obviously, we're not taking a stance on the politics of that program, but purely from a business standpoint, what does it do?
Purely economically, it provides liquidity. It's cash in the pocket for farmers to bridge the gap while crop prices are low, helps keep the farm running.
So you combine the government cash, the clearing of used inventory, and the fact that, let's be honest, machines just get old and break eventually.
That's the replacement cycle argument. The U.S. fleet age is getting high. You can defer buying a new tractor for a year, maybe two. But eventually, the maintenance costs on the old one outweigh the cost of a new one. Deere is betting that we are hitting that tipping point right now.
Let's pivot to the future stuff.
Yeah.
Because Deere really likes to call itself a smart industrial company now. They are moving beyond just bending steel into selling silicon and software. What stood out to you in the tech update?
Two big things. First is hardware independence. The Deere is launching a fully Deere-designed 20-ton excavator.
This is the one built in Kernersville, North Carolina.
Yes. For a long time, Deere relied on a partnership with Hitachi for excavator designs. That ended a few years ago, and Deere has been building its own capability.
Oh.
This launch targets 40% of the North American market. It allows them to control the entire machine design, the hydraulics, the engine, and critically, the electronics integration.
And speaking of integration, I saw the note on Tenna, T-E-N-N-A, which they picked up just yesterday. At first glance, it looks like just another software add-on. But you flagged this earlier as a potential Trojan horse moment for the construction industry. Why is this acquisition so important?
Because of what Ryan Campbell, the head of construction, admitted during the earnings call, he acknowledged that on any major job site, it's basically a zoo.
A zoo.
Yeah, you've got a Caterpillar dozer pushing dirt, a Komatsu excavator digging the trench, and a Deere loader moving gravel.
Right, it's a mixed fleet. Nobody buys 100% one brand anymore.
Exactly. And historically, Deere's software only talked to Deere machines. If you were a site manager, you had 3 different iPads for 3 different brands just to track where your equipment was. It was a nightmare.
The Tenna is basically the universal remote.
Precisely. Tenna is a platform that manages that mixed fleet. It tracks maintenance location and usage for any brand. By buying Tenna, Deere is saying, we want to own the dashboard for all your equipment, even the stuff we didn't build.
That is a fascinating strategy shift. It moves them from selling iron to selling the operating system of the entire job site.
It does. And if you control the dashboard, you control the customer relationship. You also get to see the data on how the competitors' machines are performing. That is incredibly valuable intelligence.
Speaking of valuable intelligence, the tech adoption numbers on the ag side were staggering to me. They said 99% of combines ordered this year included harvest automation technology.
99%. It's basically standard now. You almost can't buy a dumb combine anymore.
And nearly 80% took the ultimate package, which is their highest tier of automation. They also noted that engaged acres, which is the land being managed through the Deere Operations Center cloud, rose 10% to 500 million acres.
You really have to stop and think about that scale. 500 million acres of farmland feeding data into Deere's cloud.
That's massive.
Every planting depth, every yield number, every fertilizer application, it's an incredibly formidable moat. It is very hard for a competitor to replicate 500 million acres of agronomic data to train their AI models.
Okay, we've been pretty positive so far on this deep dive. Beat and raise construction, boom, tech adoption. But it wasn't a perfect report. There are absolute headwinds, and the big one starts with tariffs.
It is a messy situation. Deere projects $1.2 billion in tariff-related costs for 2026.
Hold on. 1.2 billion. That is a massive number to just manage away.
Yeah.
I know they said they are, quote, price cost neutral, unquote,
Yeah.
but that sounds like corporate speak for passing the bill to the customer.
That is certainly a major part of it. Neutral for Deere doesn't mean neutral for the farmer. It means Deere raises the sticker price to offset the tariff bill they have to pay.
But we just established that the ag economy is down.
Yeah.
Farmers are already squeezed. Can Deere actually push a price hike right now without completely killing demand?
That's the tightrope they're walking, and that's why the efficiencies part of their answer matters so much. They aren't just raising prices, they're aggressively cutting production costs internally to balance that equation so the customer doesn't feel the full $1.2 billion.
Right.
But make no mistake, tariffs are serious friction. They are sand in the gears of the P&L. It consumes a huge amount of management energy just to stay in the exact same place, margin-wise.
It feels like running up an escalator that's going down.
Yeah.
And the other headwind is geography. While North America is finding a bottom, South America is softening.
Brazil is the main concern here. It's facing a triple whammy right now. First, high interest rates. Second, a strengthened currency, the real.
Why is a strong currency bad for them? Surely you want a strong currency raised.
Not if you're an exporter. Because Brazilian farmers sell their soybeans on the global market in US dollars. If the real gets stronger, their dollar-denominated crops are worth less when converted back to their local currency. Their margins shrink.
Got it. And the third, whammy.
Just general political caution in the region. Deere is actually underproducing combines in Brazil for the next 2 quarters.
Underproducing. So they are intentionally making fewer than they could actually sell.
Fewer than the retail demand, yes. They want to burn down the inventory levels there to prevent a glut like we saw in North America over the last year. It's a very disciplined move that it will absolutely drag on their international sales numbers for the rest of the year.
So putting it all together, we have a company that executed a beat and raise in a genuinely down market. Construction is booming thanks to infrastructure and data centers. Ag is struggling, but finding stabilization as used inventory clears out. And they're doubling down on software and tech to own the job site.
That is the summary. But I think so what for you listening is about the resilience of the industrial economy as a whole.
Go on.
We often hear about the economy as one big monolithic thing. But this report shows how it rotates. When housing is down, infrastructure is up. When farming is down, construction is up.
It's a balancing act.
Deere is proving that if you have a diverse enough portfolio, you can weather a severe storm in one sector by leaning heavily on another. It suggests the industrial economy isn't crashing, it's just shifting its weight.
It's the difference between being a tractor company and being a solutions for doing work company.
Exactly. The demand for doing work moving dirt, planting seeds, building roads is robust. Even if the financial conditions like interest rates and commodity prices make it tricky, the work still needs to be done.
And that leads to a final thought I want to leave everyone with today. Deere is effectively betting on the inevitability of the replacement cycle. They are telling us you can wait, but you can't wait forever.
Right. Machines are physical objects. They wear out.
So with fleet ages hitting absolute highs, are we sitting on a coiled spring of demand? Once interest rates drop a little more or commodity prices tick up even slightly, does all that deferred demand explode at once? And when it does, with 99% tech adoption, are we witnessing the final transition of farming from a labor industry to a software industry?
It's a powerful question. When the tractor drives itself and the construction site is managed by an algorithm, the company selling that software becomes something much more powerful than just a manufacturer.
Something to chew on, for sure. That's it for this deep dive into Deere's Q1 2026 earnings. Thanks for listening, and we'll catch you on the next one.